Welcome to The Explainer. Today we're stepping into a completely fascinating role, the financial detective. We all hear what businesses claim about their skyrocketing success, but today we're cutting through the PR. We're going straight to the exact documents they use to tell their true financial story, and we're going to learn exactly how to decode them.
Because really, it brings up the ultimate question, doesn't it? How do you prove a business is actually healthy? Whether you're thinking about investing, maybe partnering up, or just trying to analyze a competitor, you can't just take their word for it. No way. We have to systematically interrogate their core financial statements to uncover the hard evidence.
So here's our roadmap to crack the case. First, we'll establish the rules of preparation. Then, we'll interrogate the profit or loss, track changes in equity, assess the overall financial position, and finally, we're going to put your new investigative skills to the ultimate test.
All right, let's jump straight into Section 1, the rules of preparation, setting the ground rules.
Before we can interrogate the numbers, we absolutely have to establish the facts of the case. Every official financial statement must declare four fundamental things. You need the exact entity name, the specific reporting date, the presentation currency, and the level of rounding used. Why? Well, because this ensures absolute clarity. It stops companies from hiding behind inconsistent, muddy reporting.
Moving right along to Section 2, the profit or loss, interrogating the bottom line.
The statement of profit or loss is, essentially, a company's financial scorecard. It's this highly structured summary that tracks exactly what a company earned and what they spent over a specific period. It maps out the gross profit, all the operating expenses, and the finance costs, just to reveal if the business actually made real money.
So let's follow this financial trail step by step for a company called Smart Concepts. Starting right at the top, we have top-line sales of $937,500. Not bad. After we subtract the direct cost of those sales, we get our gross profit. We add in some minor other income, but then we have to deduct all the operating expenses. Things like rent and salaries. And finally, we pull out the finance costs.
And when you subtract every single operational and finance expense from that initial income, we land on our golden number, a bottom-line profit for the period of exactly $89,000. That right there is the undeniable pulse of the business.
Next up, Section 3, tracking changes in equity, following the owner's wealth.
To truly understand this next document, we need to define a super important term, retained earnings. Just think of this as the accumulated wealth the company holds onto over time, rather than handing it out to the owners. It's essentially the financial muscle the company is actively building.
Revisiting our friends at Smart Concepts, we're going to focus on two main things, capital and retained profit. There's a massive capital contribution of $950,000, but under retained profit, hey, there is that exact $89,000 profit we just uncovered. However, right below that, $60,000 in distributions was taken straight out of the company.
So, do the math with me. Starting with the $89,000 profit, minus those $60,000 in distributions, the final retained profit resting safely in equity is $29,000. Combine that with the initial capital, and the total wealth of the business sits at a solid $979,000.
Which brings us to Section 4, the financial position, the ultimate health snapshot.
When you're analyzing what a company owns and what it owes, you absolutely must categorize things as either current or non-current. It's actually pretty simple. Current items are your short-term flow, stuff like inventory or loans that turn over within a single year. Non-current items, those are your heavy, long-term holds. Think massive machinery or multi-year borrowings.
Now we can see everything Smart Concepts owns and owes elegantly laid out together. We start with a list of non-current assets and a hefty pile of current assets. Then, sitting right above their liabilities is that exact equity figure we just calculated, $979,000. It's all connected like a giant puzzle.
And this reveals the fundamental, unbreakable rule of accounting. Total assets must exactly match total equity and liabilities. They balance perfectly at $2,375,000. If these numbers didn't balance, well, you'd know immediately that someone was tampering with the evidence. Finally, Section 5, your financial detective test. Is the case closed? Okay, it's time to put your new analytical skills to work. Here's your assignment. I want you to pull up a real company's annual financial statements online, and let's see if you can answer 3 rapid-fire questions. Question 1. Can you dig into their statement of financial position and uncover the total value of their non-current assets? Remember, you're looking for those big long-term holds. Question 2. Switch over to their statement of profit or loss. What were their exact top-line sales? Go find that very first clue right at the top before any expenses start muddying the waters.
And question 3, stay right there on the profit or loss statement and scan all the way down to the bottom. What was the ultimate profit or loss for the period? When all the dust settled, did they actually make any money?
Understanding these documents is literally like having a superpower. It lets you cut straight through the marketing noise and see the absolute truth of a business's performance. Thank you so much for joining this explainer. Now go run these numbers on your favorite company. But I'll leave you with this to chew on. If the math is so black and white, why do so many seemingly healthy companies still fail? What are the numbers not telling you? Until next time.